So looking at the activity one, let's look at the question first. We try to explain a few things before we're going to solve it. Now, even a few things will be always common in the exam, but if you remember it, that's going to be very helpful because cash flow statement, more or less the story will be same. But it is possible sometimes in the exam, it is possible they give you something, but it's a very new. Maybe you never see this one before. For example, they give you a development cost or investment income, but you're you just feel like I never practice this type of question, or like I don't know what to do. All you have to do, you have to sometimes use the common sense. For example, you need to think like, oh, what type of cost it is, and if it look like investment, it is look like financing, or because of that is the money uh, going or money coming. If you can figure out that, and that's enough for you to find it out the right answer. And another interesting thing in the cash flow or consolidation or any financial accounting question you're going to face in the exam, that is most of the time it will be balanced. So actually you know you are doing the right way or not. Anyway, let's read this question. So activity one, TICO. So below are the statement of financial position for TICO at 31st of December 2017 and 31st of December 2018. So we have 2 years. Remember that the cash flow statement always has to be based on 2 comparative years, because that's how we need to see how much cash in and cash out comparing the last 2 years. Statement of profit and loss and other comprehensive income for the year ended 31st of December 2018. Now remember that OCI or other comprehensive income is very important, because if there is any revaluation gain, for example, if the business have an asset and they revalue that asset, so this revaluation gain will have an impact on the OCI, that is other comprehensive income. We have a profit and we have a other comprehensive income together, so you need to understand that. So some profit are realized. That means it's already the cash is calculated. We already know the cash is there. But some profit is with the asset that is unrealized, that is revaluation surplus. So this type of profit will show separately under the OCI, that is other comprehensive income. So let's have a look at this one. Statement of financial position. So this is the balance sheet they give it to us. In the exam, they'll give us the same balance sheet. So looking at the asset, we have a few asset. We have a non-current asset, PPE. So we can see the last year it is 638, and this year it is 748. Now, if there is no other adjustment, for example, if there is no other information, all we have to do, we have to see how much is increasing from last year to this year. So for example, 638 to 798. So the difference will be the outflow, because the asset is increased. And how the asset is increased, how the asset come to my business if I don't buy it. So of course I paid for that. But of course it's not going to be that simple, because they will give it to us some revaluation, they will give it to us the depreciation, they'll give it to us some disposal. So we need to consider that as well. But if there is no more adjustment, that's quite simple. Last year to this year, how much is the difference is outflow. Simple as this. Same thing for the development cost. We're looking at the same way. 92 to 10 is increasing. So that means spend it more, outflow. Then we have a current asset. So for this template for the balance sheet, we know how it works. So we have a non-current asset, we have a current asset, we have a non-current liability, current liability, equity. At the end of the day, balance sheet will be matched. So you have a current asset. So inventory increase. Remember that if the inventory increase, it is cash outflow. How come my stock is increased in my warehouse? Because I buy more. And if I buy more, that means I paid for that. Same thing for the trade receivables increase. I make more sales, make more credit sale, but customer didn't pay. So that means it's outflow, it's not inflow. Cash 42111. So last year my cash was £4. This year my cash balance is 111. Then we have a total asset. So it's the total of these two. And then we have a equity and the liability. On the equity and the liability section, we can see we have a share capital and share premium. Normally these two come together. So when you do the comparison, do not make the separate, do it together. That means 280 and we have 220 plus 140. So you need to add together. So if we have 280 here, and here we have 320 plus 40, that will be 360. So how much is the difference? So we need to do it together. Share capital and share premium, always do it together. Then you have revaluation surplus. As I said, it is possible the business revalue is non-current asset, and if they revalue it, there will be revaluation surplus. And revaluation surplus have impact on the OCI, on the profit and loss account, and the balance sheet. So OCI is the other comprehensive income. Then you have retained earnings. Now, retained earnings is very interesting. So, retained earnings is the profit left over on the business. So, after the tax, if the business don't pay any dividend, all the profit left over on the retained earnings. Now, remember that any dividend paid during the year, it will reduce the retained earnings figure, because retained earnings like your savings account, like any profit you have, you put on the retained earnings. Any profit you have every year and you accumulate, you make it together. So let's say if the business is for last 10 years, how much profit you make, all the profit will be accumulated together on the retained earnings. And if you pay the dividend, then retained earnings will go down. So dividend will reduce the retained earnings, and if there is a profit, increase the retained earnings. Then we have a non-current liability. So we have a 4% loan note. So this is just a loan note. It's the way we take the loan. It's like a liabilities. For example, last year it was 100 and this year 250. That means we take some, issue some more loan notes, some money coming. So what business do is like a paper. The loan notes is like a government bond or gilt. So what happened? The people give some paper, like business gives some paper to the people and people pay for that. It's like a loan. I'm giving some loan note and give me some money. So business needs some finance, they do it. So it is increasing. That means I took more money. Then deferred tax. Deferred tax is quite interesting. Like as I said, like the business don't pay the tax on the same year, and some tax created as a current asset or the current liability. So if I don't pay the tax on time, this asset created sometime current liability, and if I need to pay more than 1 year time, it created non-current liability. Normally the tax for this year paid next year, and if I don't need to pay next year because of the timing difference, if this tax I need to pay more than 1 year, I called it non-current liability and we record as a deferred tax. Remember that if I'm getting back the tax, it will be deferred tax will be asset, and if I need to pay, the deferred tax will be the liability. It could be both. Remember that deferred tax could be the asset, deferred tax could be the liability at the same time. Because it's more than 1 year, we are showing on the non-current liability. If it's less than 1 year, we are showing on the current liability. All right, and then we have here the next one. We have here the provision for warranties. Again, because of the provision, if it is increased, it will have impact on the cash flow statement. Current liability payable increase is good for us. Normally we pay, for example, the supplier on 30 days. Now I'm paying a little bit later, so I have more cash flow with me. So it's inflow for me. Then we have a current tax payable. Remember that this is the current liability. So this is the tax for the last year 2017, tax for this year 16, and interest payable. This one I mentioned before on the last session. I told you that if there is an interest, for example, if I take a loan £10,000, and if the rate of interest is 10%, that means my interest is 10, but not necessarily I paid all the interest. If I paid all, then I'm going to minus all. But if any interest is remaining, for example, if you look at the profit and loss account here, my interest expense, that is finance cost, it was 10. Now out of 10, the 5 is still remaining. So my total interest was 10 and the 5 is still remaining. What does that mean? That means during the year I just paid 5. If my interest liability was 10, I should pay 10. But if I say at the end of the year that still I need to pay 5, that means during the year from 7 to 8, I just paid only 5, because we are looking at on the cash flow how much we paid or received, only the cash, the physical cash. So we're not going to minus 10, we're going to minus 5 here. We add back 10, but we're going to minus 5 because we paid only 5. All right, then you have a profit and loss account. We can see here we have a revenue. Revenue means the sales, cost of sales, gross profit. We have expenses. This is important, finance cost, because we need to add back and we have to minus. We add back 10, but minus 5 because 5 is still liable. Then you have a profit on sale of equipment. Remember that profit on disposal of the non-current asset. If there is any profit of selling of non-current asset, we have to minus it, because this is not our job selling the non-current asset under the trading activities, under the operating activities. So if we make a sale of any non-current asset, this is part of the investing activities, not under the operating activities. You cannot take it on the profit and loss account, because this year, for example, you sell some equipment, you're not going to sell next year, because this is not your daily work. It's not your daily business. You have a business selling the pen. Maybe you sell one computer this year because you don't need it, but not necessary every year you're going to sell the computer. So that's why it's not the place here for the uh, profit on sale of equipment or disposal of non-current asset under the operating activities. All right. Then we have income tax payable. This is the current year. As I said, we need to make some adjustment. What is the adjustment? We have to see how much was the opening tax. So it was 24. Remember that. Do not forget the deferred tax. We need to add 24 plus the deferred tax we have under the non-current liability. And then we added 30, and then we minus the closing. So 26 and the deferred. So I'll show you how does it work when you do the actual question. Just giving you some idea how does it work now. All right, then we have some other comprehensive income. As I said, if we have a revaluation of the asset, we have to consider the other comprehensive income. So gain on property revaluation. So you can see we have a gain on property revaluation, and we have income tax. Remember that if we have income tax that is relevant to the revaluation, we still need to consider as a part of the tax. So do not forget that 18 will be added with this 30. So 30 plus 18 will be the current year tax. Do not forget that. Finally, we have other comprehensive income. This is 42, and the total comprehensive income 112. That is 70 plus 42, 112. So this is the profit and loss and the financial statement. They give it to us. We did some analysis, and that will help us to prepare the cash flow statement. All right, the next one, we're going to looking at the additional information. That's the most important one. We need to understand what does that mean, the additional information. Let's look at this one. On the additional information, you can see we have here, it says depreciation of the property, plant, equipment. So I don't have to explain what is depreciation. You know, the depreciation is the reduction of the value of the non-current asset. So depreciation is not the difficult part. What is the information we have? Depreciation of the property, plant and equipment during the year 18 was 454. Now remember that if 30 in the top, we don't have to consider 30, we need to only consider 54, because we are taking off the 30 for all this number. Deferred development expenditure amortize 25, so you take 25. So you have a depreciation is 45, amortization 25, and both will be add back, because both are non-cash item. At the beginning of the lesson, I explained that if any non-cash item we have to add it back. Because of this expense, we just show in the profit and loss account, but actually we never paid any money for that. So we do not consider that. We need to add it back, because we never paid any cash for that. All right, the next one we have here, proceed from the sale of equipment. Remember, as we said, if we sell some non-current asset and if we make a profit or loss, doesn't matter, we need to record on the investment activities. So this whole 58, I'm going to record on the investing activities. Now, sometimes in the exam, they can tell you, proceed from the sale of equipment, the carrying value was 50, and the profit was 7. We sold it for 57. So that means we need to take 57. Here they're telling us the selling price, so we take only that. No adjustment is needed. The question could be tricky, but you have to understand that. So if there is a selling price, that means the profit is already inside of the 58. So I really don't have to split to find the profit. To find the carrying value, I need to minus the profit. So 58 is the selling price, and inside of the selling I make a profit of 7,000. And that means 58 minus 7, and that will give my carrying value. So it will be 51. That's my carrying value. So the carrying value of the asset is 51, and the profit is 7, that I'll minus from the operating activities, and 58 will go to the investing activities. So you need to break it down. As soon as you see any additional information, my head need to be clear. I need to know like where it is going, how's it going, so that when you start the question, we don't be confused. All right. So we have here, so 7 will go to the operating activities minus 58 investing activities. This 51 I'm going to minus from the PPE. When you calculate the PPE, so we need to minus 51. Why? Because I sold that asset. This asset is not belongs to my business anymore. So it will reduce the carrying value. Why carrying value? Because on the balance sheet, I show all the asset as a carrying value, not the selling price. Any asset I have PPE, I always record it as a carrying value. So cost minus accumulated depreciation is the carrying value. Finance costs represent interest paid on the loan notes. New loan notes were issued on 1st of January. My year is ended on December and issued on January. That means for the whole year, don't have to worry about it. But if there is a middle of the year, for example, 6 months, then I need to calculate the interest for 6 months. But they give for the whole year, I'm fine with that. The company revaluates its property at the end of the year. Company policy is to treat revaluation as a realized profit when the asset is retired or disposed of. Now it is up to the company policy. They want to treat as a realized or unrealized, but they're telling us they realize. For us, it's not our concern. If they realize, if the question tell us the business consider as a realized, then we will take it, we'll accept it. If they say they don't realize, we don't take it. But we only have to be considered, like if there is a revaluation, that will be increase the value of the non-current asset anyway. Any tax we have, revaluation surplus, we have to consider that. Here we have 8. We're going to follow our strategy anyway, regardless what they're saying here. All right, so we have here, calculate the cash paid to the property, plant, equipment for inclusion in the investing activities section in the statement of cash flow, preparing the financing activities. So they are not asking for the operating activities. They're asking 2 questions here. One is for the how much we paid for the property, plant, equipment, the PPE, and other one they're asking for the financing activities. But we're going to prepare the whole cash flow because this one will be in the exam and we need to know all its story. You just don't want to follow only 2 workings. So you will do it, but first we're going to follow that requirement, and after that, looking at this balance sheet and the profit and loss account, we're going to prepare the full cash flow statement under the indirect method under IAS 7. Okay, so let's have a look. So they give us some format. In the exam, you'll get some format, and you really don't have to write. You need to choose, like from the pick and choose from the drop down, you have to choose the right one. But remember that you have to know what you're doing, because here, if they give you 3 options, you need to choose the opening balance, balance BD. So they will give you drop down, you have to choose the right one. All right, now the first one is for the PPE. I'm going to do it in the top in the corner, because if I do here, I'm not going to see the question. So I'll do it. Where is the balance sheet? So here is the balance sheet, here is the PPE, and I'm going to do it here. So I'm going to do it on the corner. So I said workings 1, PPE. That represent property, plant, and equipment. So we need to use the calculator. Remember that every time we do the calculation, we should have our calculator and make sure you have the right figure. Now, when you have a PPE, very important to understand, we are looking at how much property, plant, and equipment we purchased during the year. That means how much cash actually I paid from the business. We're looking at this figure. So start with opening balance, balance BD. Balance BD, we can call opening balance. And this balance is the balance we have for the PPE and the quotient. So 638 is the opening balance. So balance BD. And 798 is the closing balance, balance CD. So this is easy for us. So we're going to write this one, 638. 638 is the opening balance, and we can write the balance CD as well, balance closing balance, balance CD, 798. This is the first thing we'll make, opening and closing. Now we need to do the adjustment. What adjustment? Depreciation, amortization, or for example, what's that called? Revaluation surplus or disposal. This is the only thing we're going to see. So let's look at the depreciation and amortization, anything we have. So if you go back to our additional information, so we have here, we have a depreciation is 54. depreciation of the property plant. We are looking at the property plant equipment, so you're going to look at only for the property plant. So 54 is the depreciation. So let's write it down. So we're going to write depreciation. Depreciation always reduce the value of the non-current asset. So minus 54. So 54 is gone. It reduce the value of the non-current asset. The next thing we're going to looking at our revaluation. And they said they make the revaluation gain. So revaluation gain 60. Gain on the property revaluation. This information could be here or could be additional information, could be both. So it's not necessary they have to give the same format. On the additional information or on the note, they can tell you the same thing. So you're going to write the revaluation gain. And remember that because of the revaluation gain, my total value of the asset will go up, because every time I do the revaluation, normally the price goes up. Otherwise, what's the point of doing the revaluation? So 60, that's plus. Plus, I don't have to write the plus, just the number. The next one, you're looking at any disposal. Remember we talk disposal, proceed. Proceed means disposal. I sold some non-current asset. And this is the sales value, 58. I'm not going to take the selling value. I'm taking the carrying value. So 58 was the sales value, and minus 7,000 was the profit. Remember that. If the 7,000 is the profit, I'm not going to take this one, because 7,000 is a profit. I want the carrying value. So sell price minus 7,000. So this is my carrying value or the cost. That is 51,000. I'm not going to take the 3 zeros. I'm going to say 51. Disposal 51. And disposal has to be minus because the asset is gone. So what is the story here? At the beginning of the year, my asset was 638. Okay. Then my depreciation was 54, so it will reduce my asset. Then I make the revaluation, so it's gone up by 60. And finally, a little bit of the asset I sold. Like let's say I have a 10 furniture, I sold one. So one will go down with the carrying value. Disposal, carrying value. Now, let's look at this one. So if I do this one, let's see if I do 638 minus 54 plus 60 minus 51. So I should have 593, because after all the calculation, based on this workings, I should have asset on my business 593. But when I check, I have asset for 798. So from where all the asset coming from? The extra asset, because I buy. There is no reason I buy. So if I buy, that means obviously I paid for that. So 593 it should be, but I have 798. So the difference here is 205. This 205 is the balance. 205. This is the asset I paid cash. So paid cash. That's the reason I have more asset. Because after having all this story, I should have only 593 pound asset, but I have more. And it cannot be just come like a magic. So I buy it. How much I buy new? 205. This 205 is the answer. So this is the first workings. You can see it's not very difficult, straightforward. So this one, 3 marks working easily. All right, the next one, we'll move to the next one now. So let's move to the next one. Let's clear a little bit. Move to the next one. All right. The next one we have here, that is says about the financing activity. That's quite straightforward. So we are looking at the share issue, the loan note, and the dividend paid. So let's look at this one. Again, we need to go back to our question, and normally we're going to looking at the equity section now. So financing activities, let's look at this one. So, all right. Now the workings to this one. financing activities. First, looking at the share issue. So we said share issue, we can do it together. So 280, 200 plus 80, so 280. And if we added these two, so let's use the calculator. 220 plus 140, 360. And the difference between these two, 360 minus 280, that's 80. So last year, my share capital was 280. Now it is 360. So that means it's increased. How come it's increased? Because I issued a new share capital to the people. So they paid me. So money in. So I say 80 pound is in. So 80 pound for the share capital. So proceed of share capital. You really don't have to mention the premium because share capital and premium come together. So 80. The next one we have here, the loan notes. The loan notes before was 100 and now it's 250. So it's a clear 150 is increasing. Loan notes is the borrowing again. Before my loan was 100, loan notes and the loan is the same thing. So before my loan was 100, now the loan is 250. And how come is increased? Because I took more loan. And if I take more loan, that means more money came to the business. How much more? 150. So proceed of loan notes, 150. And finally, looking at the dividend. Now, this question didn't tell us anything about the dividend. For that reason, we have to do a little bit of workings because we have written earnings. Now, you can see here, we have a 570, the written earnings. Now we have a 599. So 570 and 599. So if you find the difference, 599 minus 570, and this is 29. So my written earnings is increased by 29. So one thing we have discussed before, if there is a profit, then it will increase my written earnings. So you need to look at the profit and loss account. Did we make any profit this year? So let's look at, is there any profit during the year? So you can see profit after tax, 70. So if you're looking at this one now, profit after tax. So let's look at this one, written earnings. So we have 570 we have before. So let's look at a little bit. Okay. So 570 we had written earnings before, and this year we make another, how much we make? 70. So we said we have 70 we make during the year plus 70, and at the end of the year the closing we have 599. So 599. So how much dividend we paid? So let's look at this one. So if we have 570, 570 was my already profit in my written earnings account, and this year I make a profit of 70. So my new written earnings should be 640, but we have only 599, and the written earnings only can go down if I pay the dividend. So if I find the difference, 640 minus 599, 41 dividend is less because of what? Because of the dividend. So we said dividend paid 41. And that will tell me now how much is the total of the financing activities. So 80 plus 150 minus 41, 189. That's my financing activities. So now we have a PPE, that is 798, and we have a 189, the financing activities. So I think that's it. This is the two thing they asked for this question. Let's quickly go back and check once again the requirement. Yeah, it's a calculate the cash paid to the PPE, and prepare the financing activities. So that's it, it's done. So obviously, like as I said to you, we're going to prepare the whole cash flow statement based on this question, regardless what they're asking. But I ask you to all of you to take a note for that. So keep somewhere, write it down. Remember it, like our PPE was 798 because we don't want to do the same workings again. And the financing activity is 198. So write it down somewhere so that when we need it, we can just put this information because we already know how to do it. All right, so I'm going to clear all of this thing and we're going to start our question from the very beginning and we're going to do it together and we're going to follow the same thing the way we did before and we're going to do it from our operating activities, investing and financing for the same question you are following. So let's look at our question. All right, so let's move on and start with that. So start with our profit before tax. So according to the I7, so statement of cash flow IAS 7 indirect method. Okay. All right, so let's start with our cash flow from operating activities. So cash flow from operating activities. Put the 30 in the top. Start with the profit before tax. Need to remember the template has to be on our head, the format. Profit before tax. Profit before tax. Okay, we'll go back to our profit and loss account and the profit before tax 100. So write it down, 100. Very good. Now I'm going to add back depreciation, amortization, any non-cash item. So we know we have a depreciation 54, amortization, we have 25. So I'm going to say depreciation and amortization to make it together because we need some space. But in the exam, you have to show it separately because they'll give you 2 boxes for that. So 54 plus 25. So let me see how much it is. 54 plus 25. 54 plus 25. 79. All right. The next one we have interest. As I said, the interest we have to first, we need to add back. Later on, we see how much we paid. We need to find that. So it's the interest expense. In case if you don't see the interest expense on the drop-down list, you can pick the finance cost. It's the same thing. And interest expense is 10. And then we need to find the profit on disposal. Remember the 7? Profit on disposal minus 7. If it is a loss, you need to add back plus 7. Okay, so this is our story. This is the one we need to do before the working capital changes. Working capital changes means before the inventory, trade receivables, and the payables. So let's make this one. So we have 179 plus 10 minus 7, 182. All right. Now we need to see changes in working capital. It's called changes in working capital. Changes in working capital is the combination of 3 things. inventory, trade receivables, and payables. So let's look at the inventories. Inventories, we have from 280 to 330. So increase, I'm just going to write INC, increase inventory. So it is increased from 280 to 313. 280 to 313. Increase is not good. Why? Because it's outflow. Only the reason inventory increase because I buy more inventory, and that's why the stock is increased. And if it is increased, is cash outflow because I paid for that. Otherwise, the stock will never increase. So 280 minus 313 minus 280. So let's do that. 313 minus 280. 33 outflow. All right. The next one, we'll do the same thing for the trade receivables. Trade receivables also increase. I'm going to say increase trade receivables from 186 to 208. Same story. Increasing is not good because the customer is not paying. More credits that we make, but the customer is not paying. 208 minus 186. 22. All right. Then looking at the payable, we have under the current liability. So let's go a little bit down. So it's from 24 to 26. Again, increase. So increase trade payable. Now this is a little bit good if it is increase because we are taking a long time to pay our supplier and we have more money with us. So from 24 to 26. So that is it a payable or it is a provision? So payable from 146 to 1. Oh, sorry, it's the provision. So it's not, it's a tax actually. So you're not looking at that. So 146 to 152. So how much is the difference? But it's increasing anyway. So the same story. 152 minus 146. 6. So that means this 6 will be plus because it's a trade payable and it is good for me because I am taking more time to pay my supplier now. If it is decrease is bad, if I pay quickly to my supplier, it's not good. All right, then we have a provision. We need to look at the provision as well. So provision is increasing from 26 to 30. So it's 4. So increasing, everything is increasing. Provision 26 to 30. And we have 4. It is good. Provision, again, provision and the trade payable is the same thing. If it is increasing, that means I'm taking more time. Provision is like you holding the money. For example, let's say you throw some plastic in the sea, and the environmental agency sue you. So for that reason, you keep some money on the bank as a provision. So provision for the warranties. So last year it was 26. This year it is 30. Is increasing. So you have 4 outflow. You have some money extra on your bank, so that is money in, so it is 4 outflow for you. All right, so that's it. So we need to now find how much is the cash flow from our operation, and then we need to minus the interest paid and the tax paid. Do not forget that. So do that. So 182, then minus 33, then minus 22, plus 6, plus 4. That will give us 137. This is a big one. Remember that operating activities is the big one. The financing and the investing is not that big. All right. Now we need to make the changes. So we have a cash generated from the operation. Now we need to see interest paid. Interest paid. Remember that the interest we claim here, expense 10, it is possible it could be the same amount paid, but the question tell us the interest is still payable by 5. If you're looking at this one, so 5 you still need to pay. So from 10, if I still need to pay 5, so I just paid 5. So I say it was 10, I still need to pay 5, so only paid 5. And the tax. Now tax, we need to do the workings because we have a lot of information about the tax. So we need to do the workings. So let's do the workings. Now with the tax, we start with our opening tax. So current tax payable. So 24 need to be added with the deferred tax. So 54 and 24 need to add. So let's add this. Both are opening. So we have 54. So balance BD. Let's do it here. So 54 plus 24. Deferred tax and the normal tax. So let's take a look how much it is. So we have 54 and 24, 78. 78 is the opening balance, balance BD. Then we need to add the current year tax. The current year tax is the tax from the profit and loss account for both. Remember that for the realized and for the unrealized. That means for the income tax plus the other comprehensive income as well. So if you go back to our profit and loss account, so you have income tax, that is income tax expense 30, and for the revaluation we have income tax 18. So this is for the both for the current year. 30 plus 18, we have to take both, remember that. All right, so let's take it. So we take current year, we have 30 plus 18 for the revaluation. So it will be 48. 48, I need to add. I need to minus the closing year. Closing year, the same way do it for the opening year. So current, so these two will be added. So 76 plus 26. So closing balance. So 76 plus 26. So 76 plus 26 is 102. Need to minus that, 102. And the difference we'll have, and that will tell us how much tax we paid during the year. So let's do that. So we have 78 plus 48 minus 120. That tell us 6. And so we have 78 plus 48. It's not 120, it's 102, sorry. 102. Okay. So that will give us 78 plus 48 minus 102, 24. So this is the tax paid during the year. This is the tax I paid during the year. So this is the money actually gone because of the tax during the year. 24. Doesn't matter how much is the tax liability, whatever it is, but we are looking at how much actually tax we paid. So 24, I paid for the tax. So now I have 137 minus 5 minus 24, and that will tell me net cash generated from operating activities. So net cash generated from operating activities. So 137 minus 5 minus 24, and that will give me 108. Very careful with your calculator, because if your calculator give you the wrong number, the whole question will be messed up. All right, so 108. So first part is done. Number 1 is done. The financing we already done before, so you already have the financing. Now we need to do the investing. Okay, so I'm going to clear this part so that we can do the question in this side. This question is very interesting question. If you remember, the format is very, very interesting to do it. But do not forget the deferred tax and the provision. The template need to be on your head. Okay, so now looking at our cash flow from investing activities. So cash flow from investing activities, to this side. So cash flow from investing activities. Okay. So you're going to make some, okay. Here we have few transactions in the dividend paid and the purchase of PPE and the disposal of PPE. And if we have any other investment, we're going to look at here. All right, so let's look at this one. So purchase of PPE. So purchase of PPE. That was my first requirement for this question, remember? So we done this one on the previous working. So how we find it out? Opening PPE, disposal, depreciation, gain, and then gain on this revaluation gain, and then we found the closing balance. That shows how much you paid. So I told you to write it down, the balance. If you remember, it was 205 for the PPE. So 205, and it is a minus because we buy the PPE. If we purchase, the money has to go. So purchase of PPE. Then we have a proceed. So the question already gave it to us proceed. If you remember, 58 we have here proceed. So the whole proceed will come here. So proceed of PPE or equipment, whatever you write, 58. Money inflow, because if I sold, money has to come. So plus figure inflow. And then we have a development expenditure. Remember, on the non-current asset, we have a development expenditure under the PPE. And we have some depreciation for that as well. If you remember, it was 25, the depreciation. So it's quite simple. So 92, 110. So from 92, we need to minus 25 because that is the depreciation. So the carrying value should be, let's have a look how much. So 92 minus the depreciation 25 should be 67. But actually we have 110. So minus 110. So that tell me 43 we have for the development expenditure. So the difference between these two is quite simple, the way we did PPE. So development expenditure 43. 43 we paid, so outflow. And that's all for our investing activities. And don't have any dividend. Remember that sometimes the question try to make the student confused. They can tell you like the proposed dividend. On the note, they can tell you how the business decided to give some proposed dividend. If you see the word proposed dividend, do not consider that, because proposed dividend doesn't mean you already paid. We are doing the cash flow. We're only looking at is it already paid or not, nothing else. All right, so here 205, 58 and minus 43. So that will give us 190. 190, and it's a minus because PP is a minus 205, and this is for our investing activities. Investing activities. So we have number 2 now. So number 1 is the operating, number 2 is the investing, and if you remember, we already done the financing activities. The financing activities was 189 the last time we have done. I ask you to write it down. It was share disposal, loan note, and the dividend paid. So it was 189. So we're going to write quickly. So proceed of share capital, it was 80. And then loan notes, 150, and the dividend we paid 41, and it was 189. Okay, now we have three. So all these three we need. We have number one, 108 for the operating activities, number two, 190 and 198. So let's do this one. And we called it net increase in cash and cash equivalent. If it is plus, if it is minus, net decrease in cash and cash equivalent. So it's a net increase or decrease. You can use both cash and cash equivalent. So you're going to start with 108, 108, the first one. Then we're going to minus 190, 190, and we're going to plus 198. It could be any, it could be minus as well. So it's not necessarily always has to be plus. It could be the negative figure as well. So let's have a look. 108 minus 190 plus 189. And that gives me 107. 107 is basically the adjustment of these three. And now we need to find one more transition that is called opening cash and cash equivalent, or cash and cash equivalent at the beginning of the year. Same story, opening cash and cash equivalent, or cash and cash equivalent at the beginning of the year. So you're looking at our current asset, cash and cash equivalent. So for remember that this one, we need to always look at the current liability as well. If we have, remember that if we have a bank overdraft, we have to minus it. So don't just look at on the cash, always look at the bank overdraft as well. So let's have a look. But for this question, we don't have any bank overdraft, but it's not necessary. You're not going to see it on the exam. If we have the bank overdraft, we have to minus the opening and plus the closing and closing. We have to add both, and we need to find the closing. For example, if we have here, now let's say we have 4. The 4 is like, for example, our cash opening balance. Now, if we have a 2 as a current liability, as a bank overdraft, so it will be 4 minus 2, it will be only 2, not 4. Or if we have a 10 overdraft, so it will be minus 6. So you have to be very careful. So 4, we have nothing else. I'm going to add 4. Now you can see 107 and the 4. If we make this to add, that my closing cash and cash equivalent, or closing cash balance at the year end, whatever you say. Then we say like 107 plus 4, and that will give me how much? 111. Now I have done it correctly or not, I can check it by looking at the cash closing balance, and we can see it here, 111. And that means we say very good, well done. So we have done our cash flow and it's match. So this is the good thing on the financial accounting paper, financial reporting paper, because you can actually identify you done it right or wrong. And if it's not matched somehow, you can always go back. You can do a little bit of the checking and the working, and hopefully like you'll find it out where is the issues. But if you are careful, if you know the format, if you know the template, believe me, this paper is very interesting. And of course, like the cash flow is one of the interesting paper. And not only you learn how to prepare the cash flow, you're going to learn how to interpret it. What does that mean? That we're going to look at on our next session. I'm going to open the cash flow. I'm going to give the comment. I'm going to explain how is it work, what is the meaning of that, and how do we decide this company is doing good or not, and what is the workings I need to show on the exam day. Hopefully this information will be helpful for you, and keep practicing and make sure you make this template few times, write it down few times on the paper, make sure it on your head, because this template you cannot forget. And if you remember that, it's going to be very easier to complete the cash flow. And the way it is exactly the same way you're going to see in the exam. And this is very interesting paper. If you like it, hopefully like you will get a very good score in the exam. Thank you very much.